Howdy, folks. Welcome to the Weekly Economic Update. I am Raymond Dahlman, your humble host, and today is Monday, August 1st, 2022. Made it out of July. We didn't all melt and from the scorching heat across the United States this month, or last month. And looking at my forecast, it is definitely cooling off, so don't have too many more days where it's going to hit the 80s after this month, so... But we'll probably have snow on the ground in about 8 to 10 weeks. So I got that to look forward to. If anyone wants to come up and volunteer to help shovel snow, I will greatly appreciate the help. Anyways, if it's your first time watching, give me a big old thumbs up, a like, a share, a subscribe. I would greatly appreciate it. And let's go ahead and jump in to see how things turned out today in the markets. All right. Not a great day here domestically. It looked pretty good in the mornings, but took a turn for the worst in the afternoon. The Dow Jones finished down 0.14% at 32,798. The S&P 500 was down 0.29, closed at 4118. NASDAQ down 0.18, closed at 12,368. Small caps are also down about a third. The VIX today was up 7.08%. It's currently hovering around 2284. Moving on to the other Americas, Canada was up 1.21%. Brazil was down 0.95%. Mexico was down 1.64%. Jumped across the Atlantic. Germany finished flat at down 0.03%. UK was down 0.13%. France down 0.18%. The Euro Stoxx was up 1.49%. The Netherlands came in down 0.17, Spain down 0.87, Italy was up 0.11, Switzerland up 0.15, and Portugal down 0.43. Let's move a little further east. The MOEX out of Russia was down 1.52, while the RTSI was up 0.85. Headed over to the Asian markets, mostly green there. Japan came in up 0.69, same with Australia. New Zealand was up 0.73. Moving over to China, the Shanghai was up 0.21, the SCSE component up 1.2, the China A50 up 0.24, and the DJ Shanghai up 0.12, and the Hang Seng up 0.05. And the Taiwan weighted came in down 0.12. So it looks like most of the markets, at least the Asian markets, and but the further west you went, the more red we see across the board. So certainly not the end of the world, but you know, maybe the that rally we've been watching for the last week or two is starting to run out of steam. So we shall see. All right, well, let's go ahead and read through this week's weekly update. As far as the week on Wall Street, undaunted by another Fed rate hike and news of a contracting economy, the stock market rallied last week on better than expected corporate earnings. The Dow Jones Industrial Average was up 2.97, the S&P 500 was up 4.26, and NASDAQ up 4.7. Also, internationals rose 0.95%. Stocks rally on earnings. It was an inauspicious start to the week after a big box retailer missed earnings and reduced forward guidance on Tuesday, sparking a broad market retreat. But sentiment improved following mega-cap technology company earnings that proved better than expected. Enthusiasm gathered steam in the wake of the Fed's 0.75% rate hike, boosted by Fed Chair Powell's comments following Wednesday's FOMC meeting. Powell indicated that it might become appropriate to slow the pace of future hikes, and he didn't believe the economy had entered into a recession. Stocks on Thursday shrugged off news of a second consecutive quarter of negative economic growth to build on Wednesday's gains as fresh earnings continued to comfort, if not impress, investors. The economy contracts. The U.S. economy shrank at an annualized rate of 0.9% in the second quarter as consumers pulled back on spending and businesses worked to reduce inventories. It was the second consecutive quarter of negative economic growth, meeting the technical definition of a recession, unless you're asking the White House, and then they'll argue with you until they're blue in the face. Unlike past recessions, hiring has been strong all year with the unemployment rate near historic lows. I will agree that it's not typical, but to just poo-poo on the definition is a little concerning. The economic slowdown was attributable primarily to decreases in inventories, a deceleration in the housing market, and lower government spending. Well, that's always a good thing, to lower government spending. Consumer spending increased at a tepid 1%, well below the inflation rate during the same period. All right, economic data coming out this week. Today on Monday, we have the Institute for Supply Management Manufacturing Index. Tuesday, we have job openings and the labor turnover survey. Wednesday is the ADP employment report and the ISM services index and factory orders. Thursday, we got jobless claims, and Friday, the employment situation. Got a bunch of companies reporting earnings this week. Tuesday, we have AMD, PayPal, Caterpillar, Prudential, Starbucks, Marathon Petroleum, and Marriott. Wednesday is CVS, Fortinet, PPL Corporation, Bookings Holdings, Occidental Petroleum, Regeneron Pharmaceuticals. Thursday is Block, Twilio, Amgen, Eli Lilly, Conoco, Air Products and Chemicals, Albemarle Corporation, and Kellogg's. And Friday rounds out the week with Berkshire Hathaway reporting earnings. All right. So, some upbeat news. Earnings look pretty good. While the economy does appear to be contracting, it's kind of a mixed bag right now. Employment is pretty good, but at the same time, there's a lot of places that just can't seem to find help. All right, well, let's go ahead and read through today's market recap. S&P stutters as global growth concerns dent recent optimism. The S&P 500 struggled for direction on Monday as fresh worries about global growth overshadowed the recent bout of better-than-expected quarterly results that propelled stocks to deliver their best monthly gain since 2020 last month. Energy fell more than 3% to lead the broader market lower, pressured by a 5% slump in oil prices after the latest data pointing to weakness in the Chinese housing market and factory activity stoked fresh recession fears. Quote, increased recession fears since the release of our mid-year outlook have prompted substantial revisions to global growth, end quote, Morgan Stanley said, highlighting the lack of bounce back in China as one of the key drivers. The bank now sees global growth at 2.4%, 50 basis points lower than its forecast in May. Qatar Energy, APA Corporation, and Halliburton Company were among the worst performers in the energy sector, falling more than 4% each. Treasury yields, meanwhile, appear to be pricing in the increasing prospect of a recession as a key part of the yield curve. The 2-year Treasury yield over the 10-year Treasury yield further inverted, a harbinger of a recession or for a recession. Against the backdrop of an ongoing inversion in the yield curve, banking stocks struggled, pushing the broader financial sector more than 1% lower. Tech, which was the forefront of the broader market bounce back since mid-June, following quarterly results that weren't as bad as feared, struggled to turn positive. Alphabet, Microsoft, and Apple were in the red, with the latter reportedly set to kick off a 4-part bond sale to strengthen its balance sheet that will support buybacks and dividends, Bloomberg reported. So they're going to borrow money to pay dividends? That doesn't seem real good. Twitter fell 2% despite Greenlight Capital announcing a new stake in the social media giant, betting that the latter will emerge victorious in its court battle with Elon Musk to force the billionaire to follow through on its $44 billion deal to take over the company. Semiconductor stocks gave back some of their earlier day gains as weakness in Taiwan semiconductor manufacturing and ON Semiconductor Corporation offset strength in NVIDIA and AMD ahead of an important week for chip makers. AMD is set to report quarterly results on Tuesday. In other news, Boeing jumped 7% on reports that the FAA has approved the jet maker to restart deliveries of its 787 Dreamliner. All right. So again, it's not all bad news out there. There is some good news to look at. So next on some good news, oil sinks about 4% after weak factory data sparks demand concerns. Oil prices dropped about 4% on Monday as weak manufacturing data in several countries weighed on the demand outlook, while investors braced for this week's meeting of OPEC and its producer allies on supply. Brent crude fell $3.94 or 3.8% to settle at $100.03 a barrel, having fallen to a session low of $99.09 a barrel. U.S. WTI fell $4.73 or 4.8% to settle at $93.89 a barrel after hitting a low of $92.42. A break for Brent prices below the support level of 102.68 could trigger a drop into the range of 99.52 to 101.26. Reuters technical analyst Wang Tao said factories across the United States, Europe, and Asia struggled for momentum in July as flagging global demand and China's strict COVID-19 restrictions slowed production, surveys showed on Monday, likely adding to fears of economies sliding into recession. Brent and WTI both ended July with a second straight monthly loss for the first time since 2020 as soaring inflation and higher interest rates raise fears of recession that would erode fuel demand. Analysts in a Reuters poll reduced their forecast for 2022 average Brent prices to 105.75, their first downward revision since April. Their estimate for WTI fell to 101.28. However, questions about global supply loom in the oil market. Quote, there is still a disconnect with economic data and what we're seeing on the supply side, said Phil Flynn, an analyst for Price Futures Group. Quote, the oil market is still very tight and the market is going to be on edge going into OPEC, end quote. The Organization of Petroleum Exporting Countries and Allies, including Russia, together known as OPEC Plus, meet on Wednesday to decide on September output. 2 of 8 OPEC Plus sources in a Reuters survey said that a modest increase for September would be discussed at the August 3rd meeting. The rest said output is likely to be held steady. And that's what I've been seeing as far as news across my desk. U.S. President Joe Biden visited Saudi Arabia last month. Quote, while President Biden's visit to Saudi Arabia produced no immediate oil deliverables, we believe that the kingdom will reciprocate by continuing to gradually increase output, RBC Capital analyst Halima Croft said in a note. While OPEC Plus aimed to have fully unwound its record output cuts by this month, data showed the group as of June was still almost 3 million barrels per day short of its output target, as some producing countries struggled to bring wells back online. Also weighing on prices was a rise in Libyan oil production, which hit 1.2 million barrels per day, up from 800,000 barrels per day on July 22nd, after the lifting of a blockade on several oil facilities. You know, personally, my personal view is we really won't see a retracement in overall inflation across the board until energy prices start to subside. And what I would look for is oil, probably between $60 and $80 a barrel would be, considered normal right now. Based upon the, inflation of the money supply, that would be my rough guess on where we should expect things. All right. Next article has to do with housing. Housing correction is dead ahead, warns Moody chief economist Mark Zandi. Here's how he sees things playing out over the next several months. So let's see what he has to say. Existing home sales showed a 5.4% decline in June from May, but prices remained elevated, according to the National Association of Realtors. The median sale price of existing homes in the U.S. is set to set a new record high of $416,000 in June, marking a 13.4% increase from a year ago. Yet for those continuing to watch these rising home prices, chief economist for Moody's Analytics, Mark Zandi, warns that a correction could be, quote, dead ahead. But not as many fear a crash, he says in an interview on CNBC's Fast Money. Mortgage rates continue to climb as interest rates rise further, with some forecasting in the short term of a rise of 3.25%. On a 30-year fixed rate loan, mortgage rates are now sitting at about 6%. As these rates rise, mortgage payments can be several $1,000s higher than they were a year ago, Zandi says. And this loss of affordability is exactly why he sees a correction in the near future. Quote, if we stay around 6, I think the market will adjust and will eventually get that correction. If it goes much higher than that, we'll get a more significant pullback in the housing market, end quote. Fed Chairman Jerome Powell on June 14 told millennials and other first-time homebuyers that right now is not the time to invest in housing. He said in his speech that prices may continue to climb for a while as it continues to be a tight market. Quote, if you're a homebuyer or a young person looking to buy a home, you need a bit of a reset, Powell said. We need to get back to a place where supply and demand are back together and where inflation is down low again and mortgage rates are low again, end quote. Yet even as the Federal Reserve continues to work, quote, really hard to slow the economy's growth in inflation and mortgage rates, housing prices keep rising. Housing is the most rate-sensitive sector of the economy, Zandi says, and therefore is likely to be the first to feel the effects of inflation. And that includes slowing housing prices as mortgage rates continue to rise. Quote, this is the script so far, exactly what the Fed would want to see, end quote. Meanwhile, institutional fund giants like Blackstone and Broomfield are buying up houses to rent them out at high rates, something that Zandi believes is likely here to stay, even with higher mortgage rates. That's because these institutions have raised a significant amount of capital in recent years and need ways to deploy it prudently, and investing long-term in real estate is a perfect option. Zandi suggests these long-term investments are why we're unlikely to see a housing crash. These are long-term investments that won't be sold overnight, creating stability in the market. Quote, I think this is a business model that works. I don't think they're going to sell. They may not buy in this environment. They may wait and see how things shake out, end quote. So if you're in the housing market or you're planning on getting in the housing market, I personally would wait a little while until interest rates top out and maybe start to pull back. It might take you a year or two. You may have to rent in the meantime, or make other accommodations. But right now is probably not the best time, just because prices are peaking right now. Interest rates are going to continue to go up for the foreseeable future, at least until inflation starts to fall. So that would be my best suggestion there. All righty, last article here comes from our friends at First Trust. It's called Monetary Muddle. The Federal Reserve raised short-term interest rates by 0.75 percentage point on Wednesday. The day before, the Fed had released the M2 money supply data for June, and it fell slightly, the second decline in 3 months. At his press conference after the rate hike, Fed Chair Jerome Powell was vague about the Fed's future intentions on rates, but was not asked one single question about the money supply. For now, the federal funds rate at 2.375. The futures market is leaning towards a rate hike of 50 basis points in September. The Fed has apparently abandoned forward guidance, partly because it has already pushed rates close to what many Fed members said is, quote, neutral. Meanwhile, the 10-year Treasury yield has fallen from north of 3.4% to under 2.7%, suggesting the market thinks the Fed will either slow down rate hikes or maybe even cut them next year. Unless inflation falls precipitously, this makes no sense. Core PCE inflation is closing in on 5%, and a neutral interest rate should suggest at least that or higher. The Fed has never managed policy under its new abundant reserve system with inflation rising this fast. No one, even the Fed, knows exactly how rate hikes will affect the economy under this new system. Many think the economy is in recession already because of 2 consecutive quarters of declining real GDP, but this is a simplified definition. Go to nber.org to see the actual definition of recession. The broad array of spending, income, production, and jobs data rose in the first 6 months of 2022. GDP is not a great real-time measure of overall economic activity for many reasons. Jerome Powell does not think the U.S. is in a recession, and neither do we. What we do know is that inflation is still extremely high, and the only way to get it down is to keep it down by slowing money growth. And that does not look like it's happening. So far this year, M2 is up only about at a 1.7% annual rate after climbing an 18.4% annual rate in 2020 and 2021. By contrast, M2 grew at a 6.2% annual rate in the 10 years leading up to COVID. Slow growth or even slight declines in M2 is good news. The problem is that the Fed never talks about M2 and the press never seems to ask about it. Moreover, slower growth in M2 may be tied to a surge in tax payments. When a taxpayer writes a check to the government, the bank deposits in M2 fall. Data on deposits at banks back this up. However, banks have trillions in excess reserves, and total loans and leases are growing at double-digit rates. At this point, it's not clear that the new policy regime can persistently slow M2. Will higher rates stop the growth of loans? This looks to be happening in mortgages, but it appears to be demand-driven, not supply-driven. The bottom line is that the Fed seems determined to bring inflation down, but thinks raising short-term interest rates all by itself can do the job effectively, even at the same time that it is willing to hike more gradually when inflation is well above the level of rates. This is not a recipe for confidence in the Fed. Expect rates to peak higher than the market now expects, and keep watching M2. I definitely would agree with that. Whether or not we're in a recession or not in a recession, technically, the economy is in kind of a mess right now. And while some things look really good, other things are, number one, inflation has just been a complete disaster over the last 2 years. And, there were some of us who were complaining 2 years ago when, all those stimulus bills were in the works and all the handouts and everything else that the government was promising to, keep us afloat, even though we really didn't need it. Everyone else was cheerleading, hey, yeah, just drop the money out of helicopters. It'll be all right. Well, now we're dealing with those consequences. So if you're going to point fingers, I'd point it directly at the Fed, at politicians in Washington. They're the ones who put us in this spot. And, now they're going to, with the inflation reduction bill that is in the works right now, spending more money to reduce inflation seems kind of counterintuitive, and I don't think it's going to work out the way they planned. Seems like more handouts and, green energy garbage that it's going to cost us more money in the long run. And will it do anything for climate change? I don't know. I'm all for a clean environment, but my personal belief is that the federal government is the worst possible people to try and implement that. It needs to be done at the private level. So anyways, all right. Well, that's everything I had for today. I hope everyone has a wonderful Monday evening. And the Astros did pretty good over the weekend. I didn't say too many good things about them late last week. Took 3 out of 4 from Seattle, which was nice. Should have won that game on Saturday, but they blew it. They're still at home playing Boston this week. Tonight's game will be on ESPN. And so please check them out and root on the good guys. All right. Well, hope everyone has a fantastic night. I'll be back tomorrow with the Liberty Call and talk to you then. Bye-bye.